Welcome to our lesson 3 of BSc 813, Financial Accounting. And in this lesson, we are going to address the fundamental accounting concepts. I expect that by the end of this lesson, you will be able to apply these concepts in dealing with various accounting issues. What are accounting concepts? Accounting concepts are principles that are put in place to ensure that accounting information presented in the financial statements of an entity is given truly and fairly. They are the ground rules for financial reporting. The concepts include fundamental assumptions and principles. I want us to have an overview of the various fundamental assumptions and principles and conventions. We have the entity concept. According to the entity concept, the reporting unit is assumed to be separate and distinct from those who formed it and those other entities. This implies that when it comes to reporting, you do not mix the affairs of the entity with those of the owners or with those of other entities. The next one is the going concern assumption. According to this concept, it is assumed that the organization will continue in operational existence into the foreseeable future and that it has no intentions of winding up. Now, this assumption affects the classification of assets and liabilities in the statement of financial position. The next concept is the periodicity assumption. According to this concept, it is assumed that the infinite life of the entity is divisible into artificial time periods. Each of the period is referred to as the accounting period. And it is required that at the end of each accounting period, the entity should report on the financial performance and position of the entity by preparing financial statements. The next concept is the monetary unit measure assumption. According to this concept, money is assumed to be the common denominator of value. This means that all transactions and events are recorded in terms of money. If something or a transaction cannot be valued in terms of money, then it cannot be recorded in the books of accounts. The next concept is the historical cost concept. According to this concept, transactions and events should be first recognized in the books of accounts at cost. Cost implies the consideration paid or received at the point of the transaction. Cost is objectively verifiable, and that's why it's preferred for recording the transaction initially. The next concept is the revenue recognition principle. Now, this principle provides guidance on when to recognize revenue. To recognize means to include something in the books of accounts, to include something in the financial statements. So according to this principle, revenue can only be recognized as having been earned or realized when a number of conditions are met. And the basic conditions are as follows. Number one, the entity has substantially fulfilled its part of obligation in earning that revenue, and there is objective evidence relating to the amount of revenue earned and collection of that revenue. The next concept is the matching concept or the matching principle. According to this principle, the revenue earned in a given accounting period should be matched against the effort or the cost incurred to earn that revenue in order to determine the net income for the period. Next, we have the objectivity principle. According to this principle, the measurements used in recording transactions should be unbiased, which implies that they can be independently be validated by an independent person. The next principle is the consistency principle. According to this concept, similar items should be accorded the same treatment, and this treatment should be the same year after year. Nevertheless, if a firm finds it necessary to change an approach or a method of dealing with an item, the change in the method must be fully disclosed in the notes to the accounts that are normally annexed to the financial statements. The next principle is the full disclosure principle. According to this concept, any matter that can possibly affect the user of the financial statements decision must be fully disclosed in the financial statements. The next principle is the materiality concept. An item is considered to be material if its omission or misstatement can affect the decision of the user. So according to this principle, more focus should be accorded to matters that are material, and less focus accorded to matters that are immaterial. So in addition to those concepts, we have accounting conventions. So what are accounting conventions? Accounting conventions are customs that address contradictions. They are traditions that have been accepted and adopted in addressing contradictions in financial reporting. So this includes, number one, the prudence concept. The prudence concept is also known as the conservatism concept. And according to this concept, the accountant should play it safe. The accountants should play it safe, which implies that given two or more alternative ways of dealing with an item, select the option that does not exaggerate the profit or the economic benefits. The concept is applied when it comes to valuation of items like inventories. You choose the value that is less between the cost of the inventory and the net realizable value. This concept argues that you can recognize anticipated losses, but you cannot recognize anticipated gains. The next principle is the substance of a form concept. And according to this concept, whenever there's a contradiction between the economic reality of an item and its legal reality, the economic reality overrides the legal reality. The next convention is the materiality concept. According to this concept or tradition, matters that are material should be accorded proper accounting treatment, whereas those items that are immaterial should be given the simplest accounting treatment possible. You should always weigh the cost and the benefit of processing the transactions and presenting the same. That brings me to the end of the lecture. Remember to interact with the discussion forum and post your responses.